You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Bootcamp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. Most options trading platforms are commission-free, and there are some that don't charge per contract fees. Public.com goes a step further. When you trade options on Public, there are no commissions, no per-contract fees, and you get a rebate of up to 18 cents per contract traded. That means it costs less than $0 per transaction. In other words, instead of paying to place options trades, you literally earn money, and that money can add up fast. If you trade 1,000 option contracts on Public, you'll earn up to $180 in rebates. 10,000 contracts? Up to almost $1,200. It's pretty obvious why NerdWallet recently gave options trading on Public 5 out of 5 stars. Because Public really stands out for the cost of its options trades. Their words, not ours. If you want to start paying less than $0 to trade options, check out Public.com and get a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. U.S. members only. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody. That music means we are back. It is Education Wednesday. Once again, time for a little bit of Options Boot Camp. Did you miss us? You know, if you're listening on demand, you didn't really notice much of a difference. You still got your episode at the same bat time, same bat channel last week. But of course, we are back live this week for a little bit of OBC and raring to go. My name, of course, Mark Longo from theoptionsinsider.com. Hope you're having a great trading week out there. Remember, if you like what you hear, this show, anything else, throw a like, a star, a comment. It does help new people continue to discover the content, no matter where you get it. Could be on YouTube, could be on Audible, could be on Apple Podcasts, could be via the app stores for our app, like KG did. She said, 5 stars. This is the gold standard in options, news, and education. Thank you, Mark and Friends. I like that. The Mark and Friends show. I'm going to start calling it there. That, of course, was for our app, which has everything you may have seen recently. We did break Spotify. We have too much content for them to handle. You can still get it all via the apps. That's a place I do recommend you check out. And, of course, our website has it all there as well. So if you want to go deep into the archives, those are the places for you. And, of course, if you want to go above and beyond, you want to get a lot of new stuff in your ear holes right now, only one place to go, theoptionsinsider.com/pro. Great pro Q&As, awesome options oddities, giveaways, all sorts of fun. Theoptionsinsider.com/pro is the place to go. As we go and see who's joining me for the And Friends edition of the show today. Oh, yeah, it's the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show. How was your 4th of July? How many hot dogs did you eat, sir?
Well, it's funny you should ask. I had 2 hot dogs and a brat because we had a little, thing where we're trying to decide if Chicago-style hot dogs or Coney dogs are the best. But then, we had brats too on the side. And
what was the ultimate determination? What was the winner?
Well, I'll tell you what, man, I'm a Chicago guy through and through, but the Coney dog is the superior sausage.
Yeah, Chicago dog can be a lot for people. It's like a salad on a bun. So I can see why some people are a little bit put off by it. But it's a fun experience. It's not just a plain hot dog, that's for sure. The Coney has almost like a chili kind of sauce on it, doesn't it?
Yeah, it's like chili, but they don't necessarily call it chili. They call it just loose beef. And yeah, I mean it's a superior hot dog to the Chicago style. I got to tell you, I know I feel like a traitor saying it, but
heretic. You also hate deep dish, and you love ketchup on your hot dogs, which is
fuck. Don't even say ketchup on a hot dog.
I will go to bat for ketchup on a hot dog. It is delicious. We can have that discussion for another day. A hot dog, not the same as a sausage, just because they're cased meats. But I digress. Instead, let's keep on rolling, listeners, into a little bit of the options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, welcome to the options drills. And you know what? I think that's a fun flash poll to have our audience decide live here during the show. Is it ever okay, listeners, to put ketchup on a hot dog? Very simple, yes or no. Producers, get that out to the masses. We'll let you folks, the ultimate. I know we have a lot of Chicagoans who might vote one way. We have a lot of people from far hinterlands and even beyond the shores of the U.S. where they're like, what the heck are you talking about, hot dogs and ketchup? So make your voices heard. That's why you got to give us a follow at Options. All sorts of fun popping off there during the week. This week, though, a little bit of options drills. Dan, this was inspired by a recent newsletter you put out to your subscribers saying effectively you think there's a downturn coming in the market. You are not alone. Stock Twitch is putting out, I believe this morning, obviously we're at new, fresh, all-time highs in the S&P. As we're recording this, listeners, just hit 5,600 for the first time ever. They are putting out as well that their sentiment on SPY in terms of what they're tracking on their website, what people are saying, is currently bearish. They're saying long-term it could trend again towards bullish, but right now it is definitely hanging out in the bearish camp. So, Mr. Dan, you are not alone in thinking perhaps we're due, perhaps overdue for a little bit of pullback here. Tell our listeners, why do you think that, sir?
Well, I mean, first of all, there's a lot of reasons. I mean, right now we do have RSI clearly in overbought territory. It can remain in overbought territory for a long time, though. I prefer to wait until it starts ticking back down and crosses back south of that 80 line. If you look at the trailing 12 months PE ratio, we are at an extremely high level. We're at 29.18. And if you go back 10 years, there's only been two eras where the trailing 12 months PE ratio has been this high. One was in the 2008 financial crisis, where earnings just fell apart and, the market went down a lot, but stayed up enough to keep the PE ratio elevated. And then the other one was COVID. And COVID, same thing happened. The economy shut down, and so earnings went to hell. And the market went down, but, still stayed up enough to keep that PE ratio higher. So looking at the trailing 12 months PE ratio, we're at an extremely historically elevated level. Now, I'm trying to do a good job looking at the forward PE ratio. And I'm trying to get really accurate data on that so I can make sure I'm saying things exactly accurately. Let's see here. But that's a little high. Oh, there we go. Yeah. So this would be as of all time. Why they even put the all time in there? Yeah. So, well, no, actually, I'll tell you the truth. That's actually fairly high as well. So, I mean, to me, those are the big metrics. Are the P/E ratio, trailing 12 months, and forward, which is a projected number. So let's talk a little bit more about the forward P/E ratio. That is when they pool all the analysts' estimate for earnings going forward for, I guess it's 12 months. And there's some rosy forecasts out there. And it's pretty hard to discern information. Even the, Goldman financial analysts making $500,000 a year, even the, PhD economists have a hard time putting together this information. But as we see the labor market getting softer, it seems to me we're going to see those forward PE ratios coming down. So I might be early, might be ahead of things, but it just seems like there ought to be a pullback pretty soon based on the data that I'm reading.
I can't say I disagree with you, sir. I've been kind of looking skeptically at this bull run for a little while, though, so I don't want to be the anti-cheerleader for all the folks out there. But I know there are a lot of bulls in our audience, including your beloved Uncle Mike, who I believe owes you a few dollars from our wager from a few years ago. That deadbeat Mr. Uncle Mike, never going to pay up. But a lot to unpack out there. By the way, if this is a topic that intrigues you, you want to do a little bit more deep diving into our archives, listeners, you can do it on the website, do it on the app, or if you have a platform, I'll let you go a little bit farther back, you can. We talked recently, again, we're talking about hedging broad-based portfolios today. If you want to talk about that, we did that in episode 238 from May 23rd of last year, entitled, appropriate enough, How to Hedge a Broad-Based Portfolio Using Options. Episode 173 from February 9th of 2022, including portfolio hedge debate, plant-based meats, everyone's favorite, and gamma exposure. Episode 165 from December 15th of 2021. We talked about cheap hedges on that episode. And episode 105 from September 23rd of 2020. What a wild year, 2020. We talked about hedging crazy markets. So those are a little bit different. We're talking about high volatility and a bunch of other things. Obviously not the case right now. VIX hanging out around a 12 handle. So a little bit different in terms of what the regime we're talking about. So we're talking about preparing your broad equity portfolio for a downturn in this type of market. How can you go about doing that? Well, there's a variety of ways. We're going to mix it up a little bit here on the show today. I'm not going to talk about maybe the obvious one first. And also, I like to do the XYZ because it makes it easy for people to understand and follow along with. And also, it's broadly applicable to everyone's portfolio. I'm going to try to sprinkle in some real world data today whenever possible to give you both senses of. Let's mix it up. Let's talk about, okay, we said S&P, aka SPY, whichever your poison is. Let's go SPY. Just hit 5,600 in the SPX, 560 obviously in SPY. New all-time high. For all the reasons Dan just laid out, maybe you're a little bit skittish right now. Got a little bit of downturn fear on your brain. Maybe you want to keep the party alive. You also think maybe this thing could keep rallying. That is a situation that is ripe for the old stock substitution. If you want to find out more about that, of course, search in our archives for stock sub. We have done full episodes about it, listeners. Basic example, let's go to XYZ, trading for $100. You're long 1,000 shares, so you got $100,000 worth of XYZ. You're still kind of bullish over the next year, but we got some profits you're sitting on. Maybe you don't want to risk those all. You're worried about a little bit of a downturn. You can do a couple of things. Obviously, you could sell. And all these positions you talk about today, listeners, you could sell these outright and just get the heck out of Dodge. That is certainly an option. Not one we're going to discuss on the show today, but that is certainly an option if you are that skittish. You want to sleep at night? Hey, nothing wrong with that. Or maybe pare down some of your portfolio, sell a portion. All of those very viable options in this environment. As our buddy Uncle Mike says, never been a better time in history to sell S&P than today. So bear that in mind. Or you could turn around, dump your stock, and buy a in the money or at the money call option that goes a little bit farther out, probably at least 6 months, maybe out to a year, and use that instead. Now, what have you done? You're taking a lot of your risk off the table. but you're still playing. You still have a little bit of skin in the game out here, listeners. Let's look at SPY for a real world example. Let's say you got a ton of SPY. You're long 1,000 shares of SPY. This is the lion's share of your portfolio, lion's share of your retirement savings. As of today's new high, that's worth over $500,000. Congratulations, $560,000. You can see why maybe you'd want to protect some of that right now. So one way you can go about it is you can go out and let's say you want to keep your skin in the game for a little while longer, but also you want to make sure you don't keep all that skin in the game in terms of risk. So you can go out right now. We pulled these numbers right before showtime, listeners, so these are live. If you're listening months or years down the road, probably have to refresh. But right now with SPY at 560, you can go out and buy an almost 1 year call. Again, vol is fairly low right now, so it makes these types of strategies a little bit attractive. You can go out and buy almost 1 year to June of next year. Your choices are June or September right now, so you can't go exactly 1 year. But you can get pretty close with the June options out there. If you buy the at the money June call right now, listeners, the 560, it's going to cost you about $44.75. Remember, you have 1,000 shares of SPY, so you have to buy 10 options if you want to replicate all of that. Again, your multiplier is 100, 10 times 100, 1,000. So in this case, it's going to cost you almost $45,000, $44,750. You could say that's a lot of money, and it is. It's about 8% of your current portfolio right now. But you can also see it's not all of your portfolio. You're taking 92% of that off the table. It's also less than the money you've made just this year on your rally in SPY. So kind of an interesting way to go. You've taken most of your risk off the table, and you still have some skin in the game in case we get a continued rally, in case this AI machine, this juggernaut can't be derailed and keeps running through the end of the year. You get to play all the way out to June of next year. If you want to get a little bit meatier, you want to go a little bit more in the money, a little bit higher delta, you want to play a little bit more with each point of the upside, you can go down a little bit. Let's say down to, in our example, we're at 560 right now in SPY. What about a 545 call? In the money call, it's going to cost you about $56. So you're talking $56,000 versus about $45,000. So $11,000 more. It's up to you whether that's worth it or not. But also at the same time, you're having a higher delta, so it's going to appreciate faster as the upside takes place out there. So a lot to unpack out there. Dan, we'll start with that. What are your thoughts on something like a longer term stock substitution in SPY right now?
Yeah, I mean, if you are not in the market, I think that can make a lot of sense. I mean, if you, and I just, the one thing that I want to take a closer look at here, I'm not sure if you mentioned it or not, to tell you the truth, but let me just take a look here, is the implied volatility level. And I mean, the implied volatility level is fairly elevated out that way compared to where it is now. But, we're likely to withstand a lot of different, a few different volatility regimes between now and then. If you're out of the market, I do like doing things like that. Like one of the things that people don't think about when they talk about hedging, like whenever you say hedging, everyone thinks puts, but calls are a hedge too. Calls are a hedge against being out of the market. And that can be really, really useful.
So I want to start with calls. Mix it up a little bit, Dan. Throw people the curveball instead of just talking about puts. But you did bring up puts. By the way, that is a good point. Of course, you're looking at options this far out, listeners. You can't just look at straight where VIX is right now. VIX obviously a 30-day measure. You have to go out a little bit. So look at the VIX futures, look at the term structure a year out and see what's going on out there. Look at SPY options a year out, see what they're pricing in as well. That'll give you a good sense for where vol is almost a year from now. Going to be a very different picture than it is right now. But something to bear in mind, calls are perhaps a less heralded use case for hedging. Obviously, another downside to this, I can hear a lot of the tax advisors in the audience right now saying, oh my God, taxes. Yes, if you sell your underlying, you will take a tax hit. So bear that in mind, unless, of course, this is all done in a retirement account, in which case you're good. Just bear that in mind. You have tax liability if you do this. So that's something to bear in mind if you're going to think about this strategy. All right, let's get to the 800-pound gorilla in the room, which is what Dan mentioned, kind of puts. You're thinking about hedging a downturn in the market, you're going to look at puts, right? That's the way to go. And now there's been a lot of debate about puts out there, even going back to as recent as 2022, the most recent kind of aggressive downturn we saw in the market. And of course, people forget we were selling off into Halloween of last year in the market as well. Got down to around 4,100, maybe a little bit below, I believe, in the S&P as well, which seems like a lifetime ago. We're 1,500 handles north of that now. But we have had some sell-offs of late. There's been a lot of debate about the efficacy of puts in those scenarios. In 2022, out of the money puts didn't really serve you that well for a variety of reasons. Remember, we were starting at a very high vol environment. VIX was hanging out in the 30s or close to it. So you were paying a lot for those puts. The skew was also pretty high out there. So again, you were paying a fair amount of juice for those puts. It would take a really aggressive and sharp downturn to have those puts pay off. And that's not what we saw. We ended up seeing kind of more of a kind of trickling longer term downturn, which again is usually the death of long premium positions, even if you're buying puts. So a lot of people had puts in 2022 and they complained, oh, this sucked. This is terrible. I lost money on my underlying portfolio and I lost money on my hedge. That sucks. And I agree, that does suck. If you had a 60-40 portfolio, you also lost money on the fixed income portion. So it was a triple loser. That sucked. I agree. But we're in a different scenario right now. We're talking about current markets where we are right now, new all-time highs, vol at pretty much close to year lows right now. And also important to this conversation is the skew level. That's something you have to keep in mind when you're looking at puts. And the skew level right now in SPY, not terrible. Not perhaps as elevated as you might think, given where we are, how perhaps top-heavy we are, with everyone and their mother talking about a potential downturn. You'd be forgiven for expecting these puts to be jacked to high heaven. And yet they're not. So you're starting at a fairly low base vol level, somewhere around a 12. And then looking at the skew right now, and you could crunch these numbers in a variety of different ways. A lot of platforms will let you do it, listeners. Hopefully your brokerage platform will let you do it. If not, there's a lot of great analytics suites out there, Live Vol, Trade Alert, our buddy, the Flow Masters platform. That's the one I tend to go to. That's a very premium platform, though. But hopefully you have some analytics in your back pocket that you could help determine this. But right now, 30-day skew in SPY hanging out at about 20%. That's the 36th percentile for the year. So clearly, we're not looking at extremely elevated puts. If you'd like some historical range to put a little bit of context to that, the low for skew in terms of bid to the puts, that's what we're talking about, bid to the puts over the calls, was 12.9%. That came in February of this year, February 23rd. The high in terms of the puts being really jacked, guess what? Heading into Halloween of last year, October 13th, 33.7%. That's, of course, when we were really heading into the lows for the year, heading into that 4,100 level in S&P that I was just talking about. So right now, 20.2%, also starting at a lower base vol level. That's not a ton of money to pay for puts. So normally I would kind of hem and haw about saying go out and buy some puts. If you were looking at doing it right now, it is not the most expensive prospect out there. For example, we pulled out some numbers right before showtime, give you some real world examples. Let's go back to SPY. Let's say you want a couple of months worth of hedging. You're not going to go crazy. You're not going to go out 6 months or a year like we were just doing with the stock substitution. But you're going to go out to, let's say, September. Get a couple of months of hedging under your belt. We're at 5,600 right now. Just hit it this morning. If you go out and buy the September 530 puts, it's going to cost you $3.23 right now. So again, you're talking 30 handles out of the money in SPY, 300 handles in the S&P. So you have to be okay giving up that much of your portfolio. If you are, it's going to cost you, again, $3.23. Obviously, you have 1,000 shares like we were talking about before, so you have to buy 10 to hedge that. So your cost is only going to be $3,230 out there. So fairly nominal outlay, all things considered, about half of 1%. And that's up to you whether you think that's too much or not. But for a couple of months worth of not quite at the money protection, but a decent bit of protection. Remember, we were below 5,300 not that long ago, listeners out there, and easily could be again. So again, it's up to you whether you think that level is cheap, whether you think it's expensive, whether you think it's fair. but that's what we're looking at real world right now. Dan, what are your thoughts on the straightforward hedging with a put right now, and also some of the data I was talking about in terms of comparative skew and vol levels right now in SPY, sir?
Yeah, I mean, it's interesting that we have such a flat skew. It's freaking weird is what it is. And it makes me wonder whether there's just a lot of people who are selling the crap out of puts. And, you know, if that's the case, I mean, you could probably almost call a market top, because that always happens every time retail people are like, oh, what, you know, all I do is sell puts. You know, hey, I don't need any options education. I don't need to do spreads. I know the secret. Sell puts, make money every month. And so I think if the skew is flat at a time when a lot of people are thinking about a downturn, won't say necessarily even speculating, but think that there could be a downturn. The only way the puts don't get jacked up is if there's a lot of people selling them. And so what that means is that if we do get the market move through some of these put strikes that have been shorted, you can see some exacerbation. But you know, I mean, there's got to be a catalyst for that big of a thing. So okay, you kind of asked me two questions. That's the answer to one of them about the skew. The other is, what do I think about just outright buying puts? If you want to hedge, I love it. Now, normally I would say, hey, you know, you got to compare the implied volatility to the historical volatility. And if you did that right now, puts would look very, very expensive. But if you're trying to get ahead of it, you've got to sort of ignore that massively, massively low historical volatility. Because if we go back 3 years, I mean, the historical volatility, we're definitely in the lowest 10th percentile here. It's not sustainable at this extremely low historical volatility level. So we've just got to realize that in the long run, that's going to come up. We're going to get more volatility, and those puts aren't as expensive as they look. So yeah, short answer, that's the way. I mean, I've been buying puts. So I mean, there's your answer for that. My money's where my mouth is.
Putting your money where your mouth is, and your ketchup, dare I say it, on your hot
Dude,
dog.
don't even catch it. Carpet bag and
we're gonna see what our listeners have to say in a minute. Should be interesting. Before we get there, let's look here. You mentioned kind of a historical vol. Another way to look at that is realized volatility, listeners. Two words for the same thing out there right now. And Dan is correct. The realized or historical vol is about as anemic as we've seen in quite some time. So even with a 30-day implied vol in SPY at about a 10.5 as we started this show today, which is already anemic, and again below that VIX calculation. But again, VIX takes into account a bunch of other things, not just the 30-day at the money vol. The 30-day historical or realized vol, listeners, is a 5.8% in SPY right now. So if you compare it to that, as Dan was pointing out, yeah, anything's going to look expensive because SPY is not really moving. But if you go a little bit farther out, that 60-day realized is about 10%, which kind of lines up with where the puts are, or the at-the-money vol right now, at least. So, yeah, we're kind of in a weirdly aberrant low realized vol period right now, so bear that in mind, listeners. Let's turn it up to 11 here a little bit before we get to some of your questions and Dan's question of the week, and we find out if you prefer ketchup or mustard on your hot dogs. Let's turn it up. Let's say we said how cheap these puts are. It's a decent time to buy them if you're considering it. Let's say, you know what, that's still too rich for your blood. You want to pay nothing for your hedge. Well, we've said it before on our advisors option show, and also on this show as well. The collar, an excellent way to go about that. We just talked about the September 530 put costing about $3.23 right now as we're recording this show. Let's say you want to make that a zero cost collar. Now, Dan and I have talked about zero cost collar not really being our favorite thing. You kind of have to force things to line up and doesn't always work out that well. But for the sake of simplicity, I know a lot of you like zero cost collars. We'll keep it all in the same expiration cycle and we'll make it all zero cost for you. So 530 put is what you're buying. It costs $3.23. So obviously you need something around that level to sell to offset it. If the skew was 1-to-1, you're talking 560 is where S&P is right now. 530, you'd obviously be able to do a 590 call. And that would be about equivalent amounts of premium if the skew was flat. It's not quite there, but it's not that far away from it, actually. Again, getting back to what Dan was saying earlier, the skew right now is kind of weirdly flat. Usually you see the calls extremely crushed and the puts extremely bid. So typically you have to sell a very near at the money call and buy a pretty far out of the money put in SPY to do some sort of zero cost collar. Right now you can buy that 530 put for $3.23, and you could sell actually not quite the 590, which would be 1-to-1, but the 585 call, pretty close to it, for about $3.20 right now. So you could do that collar for a couple of cent debit pretty much right now, which is effectively zero cost when you're doing these things, listeners. So that gives you right now, you're hedged out at the 530 level in SPY, and you participate to the upside all the way up to 585. Again, this is done through September expiration, costs you nothing to put on right now. So again, another example that the skew right now, kind of weirdly flat. You can participate on a lot more of the upside in a zero cost collar right now than you typically can in SPY. So something else to bear in mind. Dan, what are your thoughts? We talked about this flat skew earlier. The fact that you can put on a fairly decent zero cost collar out here in SPY right now, sir.
Yeah, so from a pure valuation standpoint, I mean, it's a fantastic time for collars for those reasons. This is really a big time anomaly as far as this kind of thing goes. I mean, usually you'd have to pay a lot more for the puts because they'd be so much more bid relative to the calls, like Mark said. Now, the only tricky thing there is that collars can be a little bit tricky, especially in including in a market like this, because you're selling calls, and if the stock goes up through your call strike, you're going to have to manage that. Otherwise, you're going to be getting a sign and being out of the market, which you may or may not want to do, especially if you own shares at a low cost basis. Or if you have to manage, then you're going to buy those calls back at a loss and then sell more calls to make back that loss, or at least some of that loss. But then that P&L is against the put that you own. So, there's a little bit of trickiness as far as managing it goes. So yeah, I guess in a way it's the best of times and the worst of times for collars.
That also gets back to what we were saying earlier, listeners, about a potential tax hit if your underlying does get called away selling that call. So bear that in mind. If you're selling that call, you could potentially have to have your underlying called away or roll it. So just bear that in mind if you're doing this zero cost collar. Again, there's no free lunch at the end of the day. You're getting all this great stuff in this collar. There are going to be some downsides. So just bear that in mind out there. But again, a fascinating, somewhat aberrant time. So if you're a little bit skittish about these markets, those are some real easy, real world ways you can prepare yourself for a downturn in your broad equity portfolios. We prepare ourselves for a little bit of your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, let's get into a little bit of mail call business. Dan, while you're getting your question of the week ready, let's check in with our listener. Let's see what they have to say, Dan. The listeners at the end of the day, the ultimate arbiters of all things we do here on the network. We said to them quite simply, inspired by our heated debate right now with one Dan Passarelli on Options Bootcamp, is it ever okay to put ketchup on a hot dog? Very simple, yes or no. Dan, what do you think is winning and by how much?
I think that our audience has good taste, so clearly they don't want ketchup on hot dogs. It's just a ridiculous concept. So I would say that is winning by 100% because there's right and there's wrong.
You're a very dogmatic fellow when it comes to this, sir. Our audience slaps you in the face, sir. 80% right now saying yes, it is okay to put ketchup on a hot dog. Only 20% saying no. Oh, yeah, people chiming in like Noel Smith from Convex Asset Management. He's been a guest on our VolView show a bunch of times. He says, I'm from Chicago. Most people I know put ketchup on their hot dogs and eat thin crust pizzas. So he's saying, take that, Mr. Dan.
Sounds like he's hanging out with a bad crowd.
All I got to say is, who's the biggest hot dog seller in the country? Is it probably Costco? I think so. What do they offer there? Ketchup. Can 1,000 Costco stores be wrong? I say to you, the answer is no.
Yes,
listeners. But clearly, you folks have spoken, and you are the ultimate arbiter. So, Dan, by verifiable data, you are wrong. You must now do 100 push-ups in penance. And while you're doing those, why don't we get ready for the market taker question of the week?
And now, it's the moment you've been waiting for. It's time for the Market Taker Question of the Week.
All right, Mr. P, what you got for us, sir?
You know, I had a question asked me, and it's interesting. And we've talked a lot about this recently, about extended hours option trading. And you know that the CBOE, this webpage, they're trading SPX options in extended hours now. And that I wonder if that is going to be the first step of many, or if it's one of those things they're trying out, and if it doesn't work, it doesn't work. But you know, that was a question that I got, and became a discussion point between me and one of our student traders, and I figured I would share that with our listeners.
A little bit of a nugget, a little bit of a factoid for the folks out there, listeners. In terms of action, let's see what we've got going here. In terms of other questions of the week, we asked you a few weeks ago, last time we were live on the show, we said it's the start of the summer, weather is hot, and realize vol is low. As we were just saying, which option strategies do you anticipate using the most during this traditionally quiet period until Labor Day? And 54.5% of you chose short calls, puts, or verticals. 45.5% went for calendars and diagonals. No votes for long premium or other, which is kind of weird to me. I think there were some earlier. I think something got gummed up on Twitter, I think, with this poll. We also asked you last week, it was a truncated holiday week. We said, let's have some fun. NVIDIA was trading right around 124 at the time. At the end of the year, expiration day, at the end of the year, would you rather buy an at-the-money put, buy an at-the-money call, or just enjoy a fun holiday last week? And 46.6% of you said you're going to keep riding that train, buying the at-the-money call. 27.6% say you want to fade the beast, buy an at-the-money put, and 25.9% say you're out, you're just going to eat some hot dogs with ketchup and enjoy a fun holiday. Let's get out to our question of the week. This week, Dan, one that's near and dear to your heart, I know. We said it's earnings season once again. Our long-term average for earnings volatility has skyrocketed to a record 113% after last season. If you don't know any of that means, check out the earnings volatility reports that we post on our website, courtesy of our buddy, Mr. Matt, over there at ORATS. So we ask you quite simply, are we on track for another explosive earnings season? Will this cycle beat the record? Yes or no? So, Dan, do you think we're on tap for another cycle of earnings vol that exceeds our long-term average of 113% right now? Yes or no, sir?
Yes. Yeah. I think that this earnings season is a really, really big deal for a whole bunch of reasons. I kind of indirectly touched on some of those earlier, but yeah, my answer is definitely yes.
Let's see what our audience is saying. They agree with you. So you were wrong on the other one, Dan. Horribly wrong, as we might say. But yes, you are correct here. 71.4% agree with you. 28.6% say we are not going to make. Those people have not been paying attention. Two recent earnings announcements. All right, we'll get out of here on this fun one from this week. This comes from a regular listener and commenter, Diver SK, easy for me to say, Dan. He chimed in originally back in January of this year when we talked about the wheel strategy. We had Matt from Orats on. He was talking about his preferred way to do it with a 70 delta in the money call and things like that. Diver SK liked that. He said he started road testing and back testing that in AMC. He's been doing it ever since and giving us regular updates on how that strategy performs. Looks like it performed pretty well. He chimed in this week, I believe, or maybe the end of last week, to say he's liking it. It performed well for him, and he's going to start moving it on to higher price, less meme type stocks like JP Morgan or something similar. He says, unless it blows up, the yield is good. He's been running it now nearly 200 days. And then he chimed in again to say, hard to believe that podcast was around 200 days ago. Seems like yesterday. Do you remember? Of course we remember, Diver. Remember all of our episodes. They're like all of our children. But yeah, the wheel strategy is a great and unheralded, well, not unheralded, we talk about it, underheralded strategy out there. That certainly can be useful for a lot of people. I might find myself having to wheel out there in Portillo's right now. The Rock Lobster and I selling some puts, and Portillo's coming on hard times. Might be wheeling out of that stock. We shall see. So the Portillo's, the wheel, a very useful and under-heralded strategy out there. Dan, what do you have to say for our buddy here, Diver SK, who's had good luck doing Matt's wheel strategy in AMC, and he's looking to expand it maybe to JP Morgan, sir?
Yeah, that's interesting. Wheel strategy, the 70 delta one, that's where you sell a put, and then if you get assigned, you sell a 70 delta call against it, as I recall. Yeah. So yeah, that is pretty darn interesting. And I guess that stems a lot from the fact that you look at a chart of AMC and implied volatility has been pretty massively high during that period. It's actually interesting that would work so well with AMC. I mean, I got to say, if that's working well with AMC, it should work a lot better with other stocks, because AMC is sort of an anomaly. Like, the reason why I thought that strategy of Matt's would work so well is because you're always selling puts, basically, because a 70 delta call is synthetically a put. So you're always selling the higher implied volatility on the skew. But with AMC, the calls are bid. The calls have higher implied volatility than the puts. So, yeah, Diver SK, I'll be very interested in hearing about the results of experiments on other stocks if you so choose to do so.
I'm looking here. He's been sharing his data with us for a while. And he said he started off doing 2 weeks, and he graduated to weeklies. The yield was looking pretty good. So, yeah, it seems like he's done fairly well. I'll have to check in obviously AMC on a bit of a tier of late. So that could maybe impact that a little bit. But intriguing stuff. So, yeah, Diver SK. Anybody else who's out there following along with the show, trying out some of the strategies we talk about on the show? Maybe you're talking about looking at the zero-cost collars we were looking at today, Inspire, something else like that. If you're implementing them, let us know how they work. Maybe they work for you, maybe they don't. Maybe you're making your own tweaks to suit your own scenarios, your own portfolios. Hey, we're not precious here. Do what works for you. But hit us up. Let us know how they're working for you. And if they're not, let us know that as well. We're curious about all that fun stuff. We like to see how you folks are doing out here. All right, Dan is going to do it. We've been talking a lot today, but we missed the folks last week. I wanted to catch up with them and have a little bit of fun, Dan. In the meantime, Dan, if folks want to catch up with you in between episodes of this show, where should they go? What should they do?
Don't say catch up anymore, Mark.
It's PTSD for you right now.
Yeah, friends, make your way on over to markettaker.com and just go to the top right, click join free, and you'll be in our community. There's a lot of free content there, especially great for newer traders, but we've got lots and lots of good stuff for all our experienced listeners as well.
If it makes you feel better, Dan, it has dropped from 80% to now 71.4%. 28.6% of our audience agrees with you, and they're clearly wrong. They don't enjoy delicious flavors. I'm just saying, can 600 Costco stores, can they be wrong, Dan? I don't think so. The first condiment they give you, ketchup. I like mustard too. I like both of them. And some onions and a little bit of relish. Oh, now you're talking. Now you're talking good business, sir. Now, ketchup on like a brat or a Polish sausage, yeah, I agree with you. That's disgusting. That's only for horrific savages and demented people. But
Might as well put it on your cornflakes.
a hot dog is not a sausage just because it's a cased meat. Very different flavor profile. So obviously our audience savvy enough to agree with it. If you were still running your corks and knives, sir, you would understand the savvy palate of our audience, sir.
Oh, yeah, I understand it all right.
Listeners, you folks, clearly a discerning bunch. Keep it up. @Options is the place to go to follow along with all of our fun, not just ketchup on a hot dog, but all sorts of fun over there on the old Twitters. And while you're checking things out, make sure you check out our friends over there at Public. Public.com, the place to go to kick the tires and light the fires. Make sure you tell them we sent you. It goes a long way to keeping this show coming towards you. It's been coming at you for over a decade. Thanks to the support of firms like this. So go kick the tires and light the fires. Tell them what you like. Tell them what you don't like. They want all of your feedback. Again, it's a very new platform. They're looking for insight from folks like you. And make sure you kick the tires on that rebate. It's definitely something different. You're not going to see that in a lot of firms out there. Public.com, the place to go to kick the tires and light the fires. That is going to do it for us on the network today. We had a pro Q&A scheduled with one of our international guests. Unfortunately, international schedules sometimes fall apart, so we have to move that pro Q&A. I believe we're going to be doing double pro Q&As next week, so it should be fun. Look forward to that. We got the option block, I should say, coming up tomorrow with our buddy the Flowmaster. I haven't talked with him in a couple of weeks, as well as, of course, this week in futures options. Friday back again for Vol Views. Who's going to join us? Got to tune in to find out. And then after that, exclusively for our pro folks, back again with a little bit of options oddities. Head on over to theoptionsinsider.com/pro to learn more about that fun. Then we're back again next week, all the way through to next Education Wednesday, another episode of Options Boot Camp. Stay safe out there, everybody.
Check out Public.com if you want to literally earn money to place options trades. There are no commissions or per contract fees. And Public gives you a rebate of up to 18 cents per contract traded. Discover why NerdWallet recently gave options trading on Public 5 out of 5 stars. And start paying less than $0 to trade options. Only at Public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures and podcast description. U.S. members only. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.